Drop it.
Oh, welcome back. My passive income investors alike to the biggest mistake I watch investors make every bloody week as they share with me their portfolios and ask me questions. Ladies, gentlemen, why can't you just go for the easy money? And I'm going to explain to you what that is in this video as I try and Sherpa you through these very complicated subjects. So in the clarity of my transparency, as always, just slap that like button. I'd really appreciate it. It helps out my YouTube channel. But nonetheless, a lot of people, including myself, my girlfriend, family, friends, everybody I talk to ends up going down this path of looking at companies like Amazon, Microsoft, Apple, and they're like, it's so expensive. I mean, isn't there a cheaper stock in the market? And then they go and kind of listen to these hype train stocks like Nikola, and they're like, damn, this stock's up like 200% in the last few months. It's only 64 share. Why don't I just put my money in there? They end up dedicating like 20% of their income, of their asset portfolio to something like this that ends up ruining them down the road because these companies aren't easy money, guys. They look like they're easy money, but I promise you 99% of the time, they're going to screw you. And people keep forgetting that even though we talk about me specifically, I'll talk a lot about my 1% of my growth stocks being things like Tesla, things like, MindMed. And I'm going to give you a bit of an example here just so you're aware of how much I actually truly avoid these stocks. Now, before I started getting into MindMed, and again, I'm not here to talk about the speculative nature of these companies. I just want to talk to you about risk exposure and then where to just make bank, like easy bank. I want to make you guys money. I want to make you rich. I want to make myself rich. So this is just advice that works. But ladies, gentlemen, MindMed in my portfolio. Before we get on to that, let me just touch on Tesla first, okay? Tesla was my first spec play in my entire portfolio, in my opinion, like the largest spec play. And what is a speculation play? A stock that doesn't make any real money. They're stocks that trade at extreme multiples because they're looking into future ideas and, executing on these awesome projects that could be worth trillions of dollars, but they're not there yet. They have a lot to do still, guys. So Tesla for me was the largest spec play I ever took on. I put $6,000 or $7,000 in this stock. I watched it double. I pulled out my initial investment and then I just let it ride because a lot of people would look at this and be like, I got to own Tesla. Kyle's got $9,000 worth of Tesla shares. They keep going up. I need to own this stock at $1,000 a share. And that's just stupidity, utter stupidity. Tesla is way overvalued. I wouldn't recommend anybody buying it at these levels. Just ridiculous. And the fact that I have absolutely none of my own working capital in Tesla makes me not even care about the stock anymore, guys. It's all profit in there. I got lucky. You didn't get lucky. Don't go and chase the train and the hype after it's left the station. It's just stupid. So I took the Tesla money and I put it into what I call easy money. I bought Facebook stock with my initial investment. And Facebook to me isn't exactly a spec play, and I'm going to explain to you why that is. But nonetheless, guys, I put Facebook in here. I had to pull some out of this account. I put it in my other account, and now I'm up massively on my Facebook because Facebook actually is profitable. They have a proven business model, and it's what I call the easiest money in the market. Now, take a look at something like MindMed. So MindMed, I have working capital in, guys. It's a penny stock. It doesn't make a dime. It's R&D, research and development. They're just burning through capital like there's no tomorrow on a whim that, they might have something blow up in the future. Really stupid investment. I only have $1,000 in this stock. In perspective of my $150,000 portfolio, that $1,000 investment makes up 0.04%. Keep that in mind when you're making spec plays because Tesla in my portfolio right now has no exposure to any of my working capital. I didn't work to own it. It's just an invisible part of the portfolio. And if it makes a lot more money in the future, huzzah, it worked out. But right now, I don't look at it that way, guys. So when I'm taking on massive risk in a portfolio, the chances of me buying a penny stock like MindMed to any major degree is a joke. It's just not going to happen. So even though we talk about these companies a lot that make up less than 1% of our portfolio or asset allocated capital, way too many people get caught up in this junk. So let me explain to you how easy it is to make easy money in the market. And it has to do with the S&P top 10. And people are going to underlook so much of this, but I'm hopefully going to clarify this in a way so you can understand what you're doing moving forward. But we're going to analyze these top 10 stocks. So we got Microsoft, Apple, Amazon, Facebook, Google, Johnson & Johnson, Berkshire, Visa, and Procter & Gamble. And I want you to be aware that these companies are so bloody huge that the only thing that can be compared to them is countries' GDPs. I mean, take a look at this. So we got Brazil has a GDP of 1.8 gross domestic product sales. So this is just the product sales in general, the transactions that happen in all of Brazil. We're talking about 1.8 trillion. Mexico, we got 1.2 trillion. Argentina, 5.9 or 509 19 billion. So let's take a look at some of these top 10 stocks. Apple's worth $1.4 trillion. So it's only 400 billion below Brazil's GDP, and it's up 16% on the year. Apple, same deal, 1.4 trillion, up 12%. Amazon up 34%. Facebook up 8% on the year. We got Google up 3% on the year. Johnson & Johnson was green, but now is down 2%. And here we go into the worst top 10 performers. Berkshire Hathaway, obviously being like an ETF. It's kind of more exposed to the global market than it is individual stocks. We got Visa, another one, up 0.6% on the year. And then finally, Procter & Gamble only down 6%. Could you imagine what your portfolio would look like if you only bought these 10 companies, guys? I mean, you go into your portfolio right now and look at it and tell me how green you are on this year, because I'm obviously getting hurt as well because I don't have all of my portfolio exposed to these guys. But this is the easiest money without any thought in the world of taking no real risk to wake up a couple years from now and knowing that you're going to have more money. Now, yeah, they're not cheap, guys. The stocks cost a decent chunk of change, and I don't look at the value in the price. I don't care if a stock price is 2,000, 100. I only care about where they're going and how much money they are caking in the bank, baby. So let's kick it off with Apple to show you the true scale of what you're buying when you're buying a company like Apple. Right now, Apple has a total cash position going into 2020 of $100 billion. $100 billion. Try to imagine that amount of money. What could you buy with $100 billion, ladies and gentlemen? I mean, just take a look at this. Well, one thing Apple does with that is they do something called share buybacks, and they essentially are infinitely taking shares out of the public market, owning them back, meaning all these little trades that go on start becoming worth more and more. So not only is it increasing your shareholder value, your piece of the pie, is they're taking more shares off the public for people to be buying. That means that there's any little bit of hype in the market, it takes way less people to be bullish on Apple buying shares to make the stock go up. There's just so many infinite ways when you have this kind of money to constantly make sure the stock is going to go up year over year. Let's talk about Facebook. Sitting on $54 billion, ladies and gents. And I love Facebook. I think it's arguably one of the cheapest stock on the S&P top 10 list. Some of the highest margins in the game. And the coolest thing about this is let's just look at this $54 billion. What could you buy with $54 billion? I mean, we could literally own SpaceX and we could buy Nikola and still have $5 billion left over, ladies and gentlemen. Now, I know I should be more focused on, the platforms, how they're going to be generating money in the future. But at the end of the day, they have so much money, guys. If they even lose, like, let's say the iPhone just disappears overnight. What could you buy if you were Apple with $100 billion and your iPhone business just went completely kaput? I mean, you could own pretty much half the real estate here in Toronto. It's ridiculous. It's honestly staggering. When you're buying into these companies, you have to realize you're buying into one of the largest bank accounts on the entire planet. And sometimes too big to fail is a true reality of the system here, guys. And a lot of people I know might not be comfortable with these individual stocks, so you got to find a new way to approach it. I mean, go around QQQ. I mean, this has a lot of exposure to those S&P top companies. And the craziest thing about all of this, guys, is most of these companies trade for less than something like a Nikola, something like a Tesla, and yet people are always gravitated toward the hype. And I've mentioned this before, guys. If everybody and their grandmother is talking about it, and you're buying these companies at the top of the market right now, you're an idiot. You're just an idiot. I mean, I'm not trying to be rude. I'm not trying to be hateful. A lot of people just buy into these not understanding how to value them. And when something like, let's again use Tesla as an example here, guys. Tesla is trading at a multiple that is bigger than literally almost every other car company that exists, yet they're doing like an 18th of the volume in car sales still. And it's all because they're trying to prove self-driving. They're trying to prove, in-home grid systems so you can have, solar panel roofs and battery walls, but none of that has come into any true fruition yet. I mean, they're trillion-dollar ideas, but they're just not there. It is R&D, baby. I mean, that's what we're talking about with companies like MyMed, companies like Nikola. They're all technically just research and development-based companies. You're not buying into a bank account. You're buying into negative cash flows, and it's just absolutely absurd, and there's no way I could recommend to anybody buying Tesla at these levels. I would rather wait until Tesla proves self-driving and then buy into it, and yeah, you might end up paying $2,000 for the stock at that point, but at least they have a sustainable future, because where Tesla sits today, if it cannot explode into one of these ideas sometime in the near term, at the end of the day, guys, this stock price is going to implode. The same thing's going to happen with Nikola. Same thing's going to happen with MindMed. So why do you chase after the hard money when without any real thought, well, I know Facebook's going to be caking in another $20-30 billion in cash flow. That's earnings per share, baby. That's after expense in the bank. Again, that's the thing you keep forgetting as well, guys. Yeah, these companies aren't cheap, but at the end of the day, day, if Apple and Facebook are going to keep kicking in 20 to 30 billion plus in cash in their pocket year after year, how many things could you buy with $30 billion every year on the year, guys? Like, it's so stupid. It's so stupid. I wish you could just grasp the true reality of that kind of wealth and why you need to be exposed to it, because you're literally buying companies at the scale of economies, some of the largest economies in the world. So take a step back. Take a breath, examine your portfolio and allocate your assets correctly, as I expose about 40 to 45% of my exposure is just in these top 10 S&P companies. And then the rest, and again, I can show this to you guys so you get a better feel for this. All my stocks, almost all of them are in the red except for Apple and Microsoft. And my Apple and Microsoft are up so much in this account, I am up pretty drastically overall. So in this very moment, yeah, it would appear that I would probably be underperforming the S&P top 10 stocks due to the mass amount of diversification I have in these companies that are just lacklustering in capital performance. We're talking about MO, BTI, MyMed, BNS, and these are the kind of stocks that I buy for dividends, which is another thing people always turn their head away from. Yeah, Apple and Microsoft don't have the most attractive dividend, but guys, they have all the money. You want to be friends with people that have all the money. You don't want to be friends with the people that are spending all the money. I mean, you have friends out there, ball and chainers. They go to their job, they spend their money on the brand new BMW, the coolest new tech, but at the end of the day, they spent everything they have, and now they have to grind for the next decade to get to pay that debt off. I like freedom. We're here for financial freedom. So I want to steer you in the direction. I want to Sherpa you and guide you to the idea of financial independence. Baby, just listen to the easy money that is out there, guys. At the end of the day, these S&P top 10 stocks, they have that philosophy. They want more cash than debt. They want to be positive. They want to be the best. Something like, MyMed, Nikola, they're nowhere near the best yet. They got a lot of work to do, and I don't want you to have to do the work with them. So stay cool, stay awesome, and I look forward to chatting to you tomorrow.